What if you could collect thousands in premiums with a trade that wins when a stock stays within a specific range? Well, that's exactly what a short straddle does. It's a powerful income strategy in neutral markets, but it comes with unlimited risk if you don't manage it correctly. In this video, I'm going to show you how the short straddle works, how to identify high probability setups using Barchart, and how I manage the risks associated with the trade. And I'll even walk you through real examples, break-even zones, the Greeks, expected moves, volatility trends, and I'll even show you the exact profit and loss thresholds that I use to decide when to take the gains or cut the losses. Stick around to the end because this strategy can be incredibly rewarding if you know how to use it properly. And I'll show you exactly how to use Barchart to make smarter, more informed trades. Okay, let's get started. First, let's get the definitions out of the way. An option is a contract that gives you the right, but not the obligation to buy or sell an underlying security at a specific price, known as the strike price, on or before a specific date, known as the expiration date. A long call gives you the right to buy an asset, while a long put allows you to sell an asset. Now, the short straddle is a neutral option strategy that involves selling a call and a put with the exact same strike price and expiration. The resulting trade starts with a net credit, which the trader gets to keep in full should the underlying asset trade at exactly the strike price by expiration. Now, the chances of that happening are slim, but having the underlying trade at exactly the strike isn't really the goal, and I'll explain why in a little bit. Let's use an example to explain the core mechanics of the strategy. Let's say you sell a $100 strike call and a $100 strike put option on XYZ, both expiring in 30 days and each bringing in a premium of $3 per share. Since each contract covers 100 shares, you collect 600 upfront, 300 from the call and 300 from the put. And this total premium is your maximum profit. Next, let's talk about the break-even points. Since you collected $6 in premiums, XYZ can move $6 in either direction before the trade starts to lose money. That gives you a break-even range of between $94 and $106. As long as the stock stays anywhere inside that range at expiration, you make a profit. Now here's the catch. Unlike most income-generating strategies where your losses are capped, short straddles come with unlimited risk. If XYZ makes a big move in either direction, well above $106 or below $94, your losses can pile up quickly. So you're exposed in both directions. Not only that, but you also face the risk of early assignment, especially if one leg of the trade becomes deep in the money. That's why this strategy is best used when you expect very little movement around the strike price in the underlying stock. So if the stock just sits there and doesn't go anywhere, you win. Time decay works in your favor, and the closer it gets to expiration without movement, the more premium you get to keep. And that's the beauty and danger of a short straddle. I like to refer to short straddles as a Goldilocks trade because you'd want to sell them when the markets are not too hot, not too cold, but just right. They usually have roughly a 50-50 chance of profit since you're essentially betting that the stock will stay close to the strike price at expiration. So either it will or it won't. So how do you enhance your chances of success in trading short straddles? Well, finding potential trades can be difficult and definitely time-consuming, even if you have an underlying asset in mind. And this is where Barchart can help. Let me show you how. Okay, so first, let's visit barchart.com. From there, you can search for your underlying asset. Let's say you want to sell short straddles on Robinhood stock. So let's type in Hood right here and then press enter. Once on the stock's profile page, you'll see all of the details of the stock, including fundamental snapshots, analyst reviews, and more. For now, let's move to the left-hand side and click Straddles and Strangles. Then, click the Short Straddle tab. From there, you'll get a list of potential short straddle trades on Robinhood stock. When selling options, I typically go for trades that have 30 to 40 days to expiration, so it gives me more time to adjust the trade if necessary. So let's go for August 8th right here on the dropdown. Now we have a list of potential trades with several metrics and data available arranged in columns. What you'd want to do here is go to the loss probability column at the very end and click it until it shows the lowest to highest loss probabilities. And here we have a trade that I like with a 42% loss probability. So let's use that as an example. Everything you need to trade is right here. The screener recommends selling an $84 strike put and call on Robinhood stock for $4.35 and $15 per share, respectively, bringing your total credit to $19.35 per share, or $1,935 per contract. And the trade expires in 36 days. In this case, the straddle is slightly skewed towards the downside, since both the put and the call are struck at $84, while Hood stock is currently trading at $94.40. This means the call is in the money and the put is far out of the money. So why would a trader consider this setup? Because the premium received, in this case $19.35 per share, is so large, it creates a very wide profitability range. In fact, this trade profits as long as Robinhood stock stays between $64.65 and $103.35 by the expiration date. That's $38.70 worth of range, lots of room for the underlying stock to move without causing a loss. But again, the short call is in the money, so you'd face early assignment risk, and that's something you'd need to monitor closely, and I'll talk more about that later in this video. Short straddles usually come with high premiums, but the chances of keeping the full premium are low, and that's because the stock would have to trade at exactly the strike price at expiration. What you'd want is for this stock to trade within the profit zone. So, you've seen the results page has enough information to start selling short straddles. And if you were anything like me, you'd probably want to dive deeper into the trade and collect every bit of information before pulling the trigger. And that's where Barchart's new P&L charting tool helps. To access it, you can either click on the profit and loss chart button here at the top, or the icon between the trading price and the expiration date. Then, you'll get to the P&L chart. And this shows you all of your trade details, including your setup, credit percentage, break-even prices, net credit, and probability of loss. It also shows the P&L graph for the entire trade. The green section indicates profit, losses are here in red, and the arrows here show that losses go further since short straddles have theoretically unlimited downsides. The dashed green line shows your break-even prices. This is where you'd want the stock to end at expiration, so you could turn a profit. The solid green line shows the current trading price. Moving your cursor around the graph displays the specific profit or loss for each price at expiration. The P&L chart is a convenient visual representation of your entire trade, helping you quickly understand the potential scenarios that you'd face. The next tab is for the Greeks. Option Greeks are metrics used to assess how various factors like time, volatility, and the underlying trading price affect the options premiums. Since there are two legs in a short straddle trade, these are presented in net Greeks. In particular, keep an eye on net delta, which acts as a shorthand predictor of the probability of the trade expiring out of the money. Since this trade has a minus 45.47 delta, it suggests there's an approximate 55% probability that it'll expire worthless. In other words, a negative net delta, close to minus 50, typically indicates a neutral, range-bound outlook, which is ideal for a short straddle. Then there's also net theta, which indicates the daily loss in value of the trade, assuming everything else stays constant. A 22 theta suggests that the trade will lose 22 cents per day. And it being positive means that the loss has an overall positive impact on your trade. The less valuable the trade is as it approaches expiration, and the less likely it is for the buyer to exercise one of the options. By the way, if you want to know more about the Greeks, check this video up here. Now, let's head on over to the expected move tab. This is one of my favorites because it projects the range where a stock is likely to trade on your selected expiration date. It's based on 85% of the price of the at-the-money long straddle. And that range is automatically calculated and displayed as both a price range and as a percentage move. As you can see here, Hood stock is expected to trade between $78 and $110.90, with the upside break-even being $103.35 and $64.65 to the downside. This reinforces the slight downside skew of this straddle. By the way, the expected move tab also shows the latest earnings and the actual earnings move from the past 4 quarters, so you can compare real past volatility against the current projection. Together, these details gives you a full view of the stock's price movement to gauge your trade. Next is the Volatility tab. This displays volatility metrics including implied volatility, IV rank, IV percentage, short-term volatility trends, and IV averages across various time periods. What's notable here is that implied volatility is at 81%. However, IV rank is at 50.83%. Historical volatility is at about 57%, and the short-term volatility trend is falling. As far as short straddles go, this means you're enjoying higher premiums due to high IV, while you face less volatility risk since IV rank is at the middle and IV itself is falling. Next is the Trend tab, where you can see stock momentum metrics across short, medium, and long time frames. It shows the stock's position relative to the 20, 50, and 100-day moving averages, or the MA. Buy ratings are based on moving averages, so this means that Hood is trading well above its 20, 50, and 100-day moving averages. It also has a strong short-term trend and maximum trends across the medium and long term. This underscores the risk of this particular short straddle trade. You're very exposed to upside price movement. It also shows the relative strength index, which tags it as near oversold at 71.77%. with an average true range of 4.68, which means the stock has recently moved by an average of $4.68 per day. And you can see how the Trend tab is a favorite amongst technical traders. But let's go back to risk for a moment, specifically the identified upside risk. Remember that short straddles are at risk from both the upside and the downside. You also face the risk of early assignment, especially if either of these trades move deep in the money. So how do you manage that? The first thing to do is to monitor your positions. That means looking at the price, delta, theta, and volatility as the trade progresses. But what if the stock crosses above your break-even price at either the upside or the downside? I find it best to close the trade out altogether to cut your losses. And then if you want, you can sell another straddle at a later expiration date, or different strike prices, or both. Now let's fast forward a little to say a few days before expiration, and let's say that Robinhood stock still trades within your break-even prices, but one of the legs is in the money. So what do you do? Well, based on my own experience, closing a profitable short position early is generally the best approach. For this particular example, I'll close the short straddle if I can capture 70 to 80% of its max profit. Remember, I originally collected $19.35 combined for selling the call and the put. If I can buy back both of the short options for between $3.87 and $5.80, or 20 to 30% of the initial credit, I will. That way I get to keep between $13.55 and $15.48, and I never have to think about assignment again. As for losses, I typically limit them to 150 to 200% of the net credit. That means if the cost to buy back the options reaches between $29 and $38.70, I'll absolutely take a loss on the trade and move on. The point is, short straddles aren't one-and-done trades. You need to monitor your positions, check the Greeks, watch the shifts in volatility, and adjust the trade as necessary. Short straddles are a smart way to profit when you expect the stock to stay put. With this strategy, you collect a high premium upfront and benefit from time decay, all without having to predict which direction the market will move. However, it does require some decent price forecasting if you're aiming for maximum profit. That's why reviewing trade details, whether through your own broker's tools or using Barchart's option screener and new P&L charting tool, is a must. The great thing about Barchart's features is that you get immediate insight into your trade's potential profit, break-even zones, risk exposure, the Greeks, volatility levels, trend strength, and more, all in one place. So here's a challenge for you. Pick a stock that you believe will stay range-bound. Use Barchart's P&L charts to explore the trade details and understand the risk-reward profile. Then, try selling a straddle in a paper trading account. Monitor it and practice managing the position, and adjust if necessary. And once you've got the hang of it, and only once you're confident, go live. Well, that's it for me today. Thank you so much for watching, and I'll see you next time.